Welcome to Money Confessions. I'm here to help the world learn more about money and get out of debt and build wealth. Credit card debt just hit $1 trillion here in the United States, so hit the like and subscribe button so that more people can find this channel, more people can learn about money, and more people can get out of debt. Let's dive in. Confession number 1, debt payment advice. I need advice on paying debt, savings, and what accounts I should use. I'm 33 years old with $50,000 in student loan debt and about $10,000 on my car loan. My credit is good, but I have no savings at all. I finished college and started working recently. I make about $5,800 after taxes each month. Recently, my rent was raised about $2,000 after utilities included. My auto loan and student loans will be about $900 a month combined. That leaves me with some money for food, gas, and savings. Should I focus on building some general savings, Roth IRA, which is best type? Or should I aggressively pay off my debt or just be making payments? Feeling pulled in too many directions. You should not be even thinking about investing when you have $60,000 in debt. A lot of people might say if you have a 3, 4, 5, or 6% car payment, you should invest the difference. But frankly, you shouldn't, because in a high yield savings account, you are going to be paying taxes on all the interest gains. So if you have a 5% high yield savings account interest rate, then you're going to be really, after tax, you're getting about 3.5% if you're accounting for 30% of taxes. In my eyes, you should be paying off all your debt before you start investing in a Roth IRA, saving for a house. You have $5,800 a month in income coming in, about $3,000 in housing and debt payments. So we'll throw another $1,000 on top of that. So you have $4,000 a month in required expenses, which leaves you about $1,800 a month that can be going towards paying off these debts. So that means this car loan can be gone in just over 5 months. And then you can start attacking the student loans after that. Don't worry about saving for a house. Don't worry about saving for investing yet. Just make sure you're getting out of debt, and then you're going to have so much more income to be throwing at a house to save for or into retirement accounts. Confession number 2, whole life policy help. My financial advisors tell me to pause Roth payments over canceling whole life policy. I've worked with this guy for a few years, and he recently got me to invest in a whole life account. However, after a home purchase, my monthly expenses have gone up and I need to make some decisions to lower my monthly expenses. When I brought this up, I got pushed back in several emails, with the most recent telling me to pause Roth payments instead of canceling my whole life policy. I was surprised because everything I've heard from others, and him including, says it's smart to make payments to a Roth account, especially since I'm still in the lower tax bracket. Any thoughts? Is my guy worth it? Should I send him packing? Am I wrong? Should I pause my Roth payments? Yes, you should send him packing. He is telling you to pause Roth payments because that means his commission is gone out the window if you cancel your whole life policy. Whole life policies are very commission-based, fee-heavy up front, and frankly, not good investments. You're much better getting a term life policy if you have dependents or people depending on your income, and investing the difference in index funds. And if you don't have dependents, be investing that money into index funds. So whole life policies are full of fees, full of commissions, and do not compete with the S&P 500 average returns. You're not investing wisely if you're putting stuff into a whole life policy. Whole life policies, if they're being sold to you as investments, they're called whole life insurance policies for a reason. They are insurance. Insurance should not be an investment. Confession number 3, student loan help. How much of my student loan should I pay off? Now that student loans will be resuming, I need to figure out how to go about paying off my $29,000 in student loan debt. I currently have $36,000 in a money market savings account with a 5% yield, $6,000 in a checking account, and $500 in another savings account. I don't have any other debt, and I make $70,000 a year before taxes. I currently live with my girlfriend. We each pay $960 a month for rent, Wi-Fi, and electricity not included. My goal in the next couple of years is to buy a condo or a house. My girlfriend will want to go in on the investment, but she also has student loans to take care of as well. We live in an area where a decent condo costs just north of $300,000 and a decent house at $400,000. A condo would be attainable for us, but saving for the down payment is a big hurdle. Anyway, with that information, can I pay the entirety of the loans in a one lump sum, or should I pay a certain portion of it? And if so, how much? We have about $42,000 in cash between all of your accounts, and you have $29,000 worth of debt. So wipe the debt off tomorrow, and you'll still have $13,000 remaining in cash. You'll be debt-free. You won't have monthly payments anymore, and you'll never have to worry about student loans again. So pay those off. You have the cash to do it, and then start saving money for a house, for investing, whatever that might be. But please do not sit here and sit on the cash when interest is resuming, when payments are resuming. Yes, you're having a 5% high-yield savings account, which is great, but it's not going to out-earn high interest student loans. And even if your student loans are low 3-4%, once you account for taxes, it's essentially a wash. So please just get rid of the student loan debt, be debt free, don't have any more payments, and start building up your emergency fund and start building up your housing fund after that. Confession number 4, car loan help. 401k to pay off car, is it worth it? I owe about $10,000 in my car and I have about $80,000 in my 401k. I won't retire for at least 14 more years. My car loan is about 7%. My 401k loan will be 4% paid back to myself. Is it worth it? No, it's never worth it. Retirement accounts are called retirement accounts. They're not called take it out and use it to pay off car loans. It is not, hey, let's take out this money out of a retirement account and go spend it on something I can't afford. You obviously bought a car that you can't afford because you didn't pay cash for it. And if you start this cycle of taking money out of your 401k, then next year something's going to come up, oh, this vacation, or oh, this other car, oh, this, and you're going to start just pulling money out of your retirement account. You shouldn't be doing that. It's a terrible habit. It will put you in a terrible position when you go to retire in 14 years and you have no money in your 401k. So you need to be hustling to pay your car off, this $10,000. You not need to be pulling money out of your 401k for it. Confession number 5, I need a good strategy to get out of debt. I'm 29 years old, but I'm struggling financially right now. I know I make enough, but I've come to realize I am terribly irresponsible with my money. I mapped out all my spending in hopes to return to create a plan. What are some things that have helped you guys get on track financially? Well, the first step of fixing an error is admitting there is a problem or something you need to improve upon. And you've already realized that you're irresponsible with money and you want to change that. So that's step number 1. You have to make that decision to change your life financially. You have to make that decision to get out of debt. No one else can make that decision for you. Step 2 is you need to budget. You said you're irresponsible with your money. And if you're not tracking every single dollar where it's going, you're never going to know where your money is. It's going to go out just as quickly as it came in. So you need to be budgeting every single dollar, using platforms, apps to do that, and understanding where your money is going. And then you need to figure out your plan to get out of debt, whether it's the snowball method or the avalanche method. That depends on if you have credit card debt, student loans, car payments, what those interest rates are, what the balances are. But there's a lot of things for you to learn, and that comes to educate yourself. If you want to change yourself financially, you need to start educating yourself, learning about the snowball method versus the avalanche method, learning from people like Dave Ramsey or Meet Sadie, or subscribing to my channel. Everyone watching this right now, I want to help the world get out of debt, stay out of debt, and build wealth. So please hit the like and subscribe button, and people like this will find the channel on YouTube, and that will only help the world become more financially educated and just help this word get out there even more. Number 1, you need to make a budget and figure out where your money's going. Number 2, you need to have a plan on paying off this debt, whether it's a snowball method or the avalanche method. And 3, you need to be educating yourself, finding resources, websites, blogs to learn from on how to get out of debt, how to stay out of debt, and how to build wealth. Confession number 6, car purchase help. Should I pay off student loans and put less down on a car, or vice versa? I have a Toyota Corolla that I took to the shop, and it will cost at least $2,000 to fix it. At this point, I'm planning on to sell it for $5,500 to someone who's already interested. $1,000 less than I paid for it about 2 years ago. Rather than buy another used car and replace it in a few years, I think it makes more sense to get a new car. I can make a lot of repairs myself. Plus, I come from a family that has kept all of our cars for 20 plus years by repairing it ourselves. The plan would be to buy new and not get a new car for a long time. Most new cars I'm viewing are $30,000 to $35,000 total. I make $62,000 a year. I also have $10,000 in student loans, $8,000 in my emergency fund, and $23,000 in my high yield savings account. I have no other debt. Given how high interest rates are for buying a car, should I, 1, pay off my student loan debt and use the rest of my savings, about $13,000 as a down payment on the car? 2, make monthly student loan payments and put $23,000 down on the car? Or 3, forget the new car and fix the current one? Or, in my opinion, option D, and that is none of those. You have between your emergency fund and your high yield savings account, you have $31,000. So you should not be financing a car ever, especially when you have cash to pay for it. When you do, you're making $62,000 a year. You should not be buying a $30,000 to $35,000 car. But what you should do is take that $31,000 and you pay off the $10,000 in student loan debt, which would give you $21,000 left between your high yield savings account and your emergency fund, and then decide what remaining of that cash would you be comfortable with to spend on a car. If it's $10,000 and that leaves you with $11,000 left, great. If it's $12,000, whatever it is, you're comfortable with spending on cash and leaving money in your emergency fund, then do that. But please do not go and finance a new car when you're making $60,000 a year, when you have debt. You'll pay cash for it. You'll have no debt. You'll stay debt free, and you'll have a lot more freedom. Car interest rates are not fun right now. Car payments are not fun ever. So pay cash for it, pay off these student loans, and be debt-free. Confession number 7, should I buy a timeshare? I know the obvious answer, but I'm wondering if this is the 0.1% situation where maybe it's kind of okay. Situation, the timeshare is selling for $10. Yes, it is selling for $10. It's for 2 weeks out of the year. The time window floats, which is fine. We only work 3 days out of the week. We're in healthcare, so it's easy enough for us to get 2 week stretches off during the year than other holidays. The annual maintenance is $1,200. It's in Tahoe, and my husband and I live close, about 2 hours away, and already visit it yearly. Overall, the cost is less than what we normally pay for 7+ days additional out of the year. I honestly don't know enough about timeshares to know if there are some hidden surprises in there that would turn it into something not as good as it appears. Closing costs, other secret hidden fees, I honestly don't know. Or is this just something I should avoid? Timeshares are always horrible ideas. There is a reason someone is trying to sell a timeshare for $10 because they don't want to be in it. It has $1,200 a year in annual costs having it, so there's no investment side of it. It's not going to appreciate. You're not going to be able to rent it out. There's just nothing beneficial of having a timeshare. It's a headache. You read up anywhere on the internet that timeshares are terrible, and you already said at the beginning of this that it doesn't make sense for 99.9% of people. And if it doesn't make sense for 99.9% of people, it probably doesn't make sense for you. And all you're doing is guaranteeing yourself a $1,200 annual bill every single year for maintenance. Stuff is going to come up in life where you can't make it that 1 or 2 weeks that you thought you were going to be able to, and you're just going to have this recurring bill every single year. So no, please don't do this. Please don't ever sign up for a timeshare. Confession number 8. I am stuck and feel hopeless. I'm unsure on what to do or how to go about this. For some background, I'm in college and I work as an accountant at a car dealership, and I have bills to pay. I currently make about $500 to $600 a week, so about $2,000 to $2,400 a month. My tuition is $1,200 a month. My car payment is $560 a month, and I have $3,600 in credit card debt. I know my situation isn't as bad as others, but I'm struggling to find a way to pay off this credit card debt. At least $1,760 of the $2,000 to $2,400 I make a month goes towards my car and school. The rest I use on food for myself at home, gas, and other necessities. I already work overtime at work and have been told to go home early many times because I already work so much. My parents are not able to help me out because they're financing a new house and money is already tight as is. My situation is very overwhelming and it stresses me out. I feel stuck. I do not know what to do and I'm just seeking out advice. It has been like this for a year and I don't see an end. First, you're young and you are working your way through college, trying to pay for your tuition, trying to pay for all your necessities. And I'm proud of you for doing that, for not taking out student loans in this situation. I congratulate you first for that. Second, you need to really sit down and start budgeting your money. You're saying that you have this $3,600 in credit card debt, feel stuck, so you need to make sure you're tracking every single dollar, knowing where it's going. I'm sure there's things in your budget that you can cut out to help cut back on some expenses. But really what you need to look at is your main line items are tuition and your car payment are two of your biggest things. Tuition, if you're trying to finish school, you obviously cannot get rid of that and continue to try to cash flow that. But your car payment is over $500 a month. That is over 25% of your take-home pay right now. And that is a horrible spot to be in, whether you're making $2,000 or you're making $5,000, having a $500 a month car payment. So you need to look at your options with that car. Can you sell it right now? Can you buy a cheaper car? What are your options for that car? Because if you can wipe that away, that is going to allow you to get out of this credit card debt so much quicker. But with so much of your budget being taken up by that car payment, it's going to be very difficult to make ends meet to be able to get out of this credit card debt. Number one, start budgeting your money, make a plan for it. And two, look at options for your car. If you get rid of that car, it's going to help alleviate so much cash flow in your budget to be going towards this credit card debt. And three, if you have time to find things on the side, Uber Eats, DoorDash, whatever it might be, to make additional income, since you said you can't necessarily get more overtime at work. Keep your head up. Keep hustling. You're young. I'm proud of you for cash flow in college right now. Just keep hustling. This is a short season of your life. Once you graduate, you won't have that $1,200 a month tuition. So keep hustling. Confession number 9, car payment help. I financed my first car 3 months ago with a 7% interest rate. No issues. I love the car. My payment is $350 a month and I have about $20,000 left. I can make this payment no problem. I have about 5 years left on it. The thing is, I have the money in my emergency fund to pay the whole $20,000 off. Is there a specific advantage with paying the whole thing now? Yes, there is. You just mentioned your car payment interest is 7%. Money in your emergency fund is not earning 7% at all. It's probably earning a 4 to 5% before taxes. So in the 3 range after you account for taxes. So you're not earning that on your money in the bank. You're not going to earn a 7% risk-free interest rate anywhere in this world without any sort of risk. So pay off the car loan tomorrow, be done with it, and start using that extra cash flow to start building up your emergency fund as quickly as possible. Confession number 10, credit card debt help. $34,000 in debt, crazy high interest rates. I've just moved in with my father and asked if he wanted to sit down and do a budget together, as he's been mentioning lately that he needs to start saving money. We wrote down all of his debts, bills, and income and was shocked at the number. He's got a total of $34,000 in credit card debt across 5 accounts with interest rates around 30%. I did the math, and he makes enough money to pay his living expenses and minimums of credit cards and have about $1,200 left over to throw at debt. But his interest rates are so high. If I'm understanding this correctly, if he pays all of his minimums for this month, next month, I'm thinking his debt total will be $12,000 more than this month. Please tell me I'm miscalculating, misunderstanding how APR works. And if that's accurate, would debt consolidation even be an option worth considering? So to start, your APR on your credit card, whether it's 30%, whether it's 25%, whether it's 32%, is the annual interest rate. So you have a $34,000 balance, and we'll assume, just for cleanliness purposes, a 30% APR. That'd be roughly about a 2.5% monthly interest rate. So that means 2.5% on the $34,000 would be about $850 a month in interest charges. So if you're paying $1,200 a month in total payments towards that, then $850 is going strictly towards interest, and the remaining $350 is going towards paying down the principal. So no, your debt balance would not be going up to $12,000 a month. You're probably doing calculations with your APR on a monthly basis when it should have been on an annual basis. But yes, you can definitely look at options to do balance transfers to try to eliminate some of these interest rates in the interim. If you can get an introductory period that does not have interest, but you have to be very careful with those because they do have fees that have come with them, and you have to be attacking those debt during those 0% interest periods. And that's all I have for today. So thank you for watching. My goal is to help the world learn more about money, to get out of debt, to build wealth. The best thing that you can do to support me and to support America and our financial literacy is hit the like and subscribe button. That will help more people view this channel, more people find this channel, and help people get out of debt, stay out of debt. Credit card debt is raging in America today, and it needs to change. Car payments are over $700 a month on the average new car payment. Credit card debt's over $1 trillion, and that's not a spot anyone wants to be in. So thank you for watching. Hopefully you learned something, and hopefully you hit the like and subscribe button, and we'll see you next time.